How your $100 quietly lost 30% of its purchasing power. 10 years ago, $100 could fill a grocery cart in America. Today, that same $100 covers far less. According to U.S. inflation data, prices are roughly 20 to 30% higher than they were just a few years ago, depending on the category. Your paycheck number may look similar, but your purchasing power isn't. In the next 7 minutes, I'll show you what changed and why your $100 now behaves like $70 in real terms. The purchasing power shift. Between 2020 and 2023, the U.S. Consumer Price Index rose at the fastest pace in 4 decades. Groceries, rent, auto insurance, all moved sharply higher. And here's what most people misunderstand. When inflation slows, prices don't go back down. They compound from a higher base. That's the difference between nominal income and real purchasing power. If prices rise 25% and your income rises 5%, your real return is deeply negative. What happened after 2020? In 2020, U.S. GDP contracted sharply. To stabilize the economy, policymakers responded with unprecedented stimulus. Congress approved multi-trillion-dollar fiscal packages. The Federal Reserve lowered interest rates to near zero. The money supply expanded at a historic pace. When liquidity grows faster than real output, each dollar represents a smaller claim on goods and services. More currency in circulation. Limited short-term production capacity. That imbalance drives price pressure. Not overnight, but persistently. A simple analogy. Think of it like share dilution. If a company doubles its share count without doubling earnings, each share represents less ownership. Currency works the same way. When supply expands faster than productivity, purchasing power weakens. Why prices didn't fully reset? Even after supply chains normalized, many consumer prices remained elevated. 3 structural forces explain that. Force 1. Lagged monetary effects. Monetary policy works with delay, often 12 to 18 months. Liquidity injected during crisis periods doesn't disappear instantly. It filters through wages, housing, services, and asset markets over time. Force 2. Corporate pricing power. During supply disruptions, companies raised prices to offset higher input costs. That was expected. But in multiple U.S. sectors, profit margins expanded even after input pressures eased. Consumers adapted to higher price anchors. And when demand remains steady, pricing power sticks. This is less about conspiracy and more about competitive dynamics. Force 3. Inflation expectations. Inflation is partly behavioral. If firms expect future cost increases, they adjust prices early. If consumers expect higher prices, they accelerate purchases. That feedback loop reinforces inflation persistence. Once expectations shift, price levels rarely return to pre-shock baselines. That's how $100 becomes the new $70, gradually. What this means for you. You can't control Federal Reserve policy, but you can manage your exposure. 1. Focus on real returns. If inflation averages 4 to 6% and your savings account yields 1%, your real return is negative. Over time, that erodes purchasing power. That capital preservation requires assets that historically adjust with inflation. Diversified equities, real assets, productive businesses. Cash provides liquidity. It doesn't provide growth. 2. Watch the policy cycle. Interest rate hikes affect mortgage rates, credit cards, and business financing with delay. When policy shifts aggressively, borrowing costs typically adjust months later. Understanding that lag helps with major financial decisions, from refinancing to large purchases. 3. Be a deliberate consumer. In competitive markets, pricing power weakens when consumers compare, switch, and delay purchases. Markets respond to behavior. Even small shifts in demand influence pricing strategies. Your $100 didn't disappear. Its real purchasing power adjusted in response to policy, liquidity, and expectations. Understanding those mechanics won't reverse inflation, but it allows you to position your income and capital intelligently in an inflationary environment. Subscribe if you want clarity, not headlines.